Good morning, students. Welcome you all on the video lecture initiative, or I would say LVC classes initiative of Board of Studies of ICAI. I am CA Alok Garg. So this is the second class on India 16 property, plant and equipment. And today we will complete this particular chapter or this particular standard. In the last class, we discussed about why this standard has come into picture. So this standard talks about accounting treatment of property, plant and equipment, that is recognition, measurement, disclosure, depreciation, impairment. So these all requirements are dealt by India 16 with respect to property, plant and equipment. Then we discussed about on which item this standard was applicable or this standard is applicable. So we discussed this standard is applicable to all kind of property, plant and equipment except if a property, plant and equipment is held for sale. If a property, plant and equipment is used for sale in the ordinary course of business, if a property, plant and equipment is so it is a exploration and evaluation of mineral resources which is covered by Ind AS 106, or if it is a biological asset related to agricultural activity. But we have discussed about bearer plant. If it is a bearer plant like mango tree, like tea tree, like coffee tree, so these are considered under Ind AS 16, because these mango trees, tea plant, coffee plant, so these are used for providing a produce for more than one period. Then we talked about what is meant by PPE, what is meant by property, plant and equipment, and we discussed property, plant and equipment are tangible item which is held for use in production or supply of goods and services, which is held for rental purposes and held for administrative purposes and expected to be used for more than 1 year or more than one period. Okay. So we discussed about if any item of PPE which is held for rental purposes will cover under the definition of PPE except land and building. If land and building is given on rent, then it will be classified as a investment property, not as a PPE. It will not cover under Ind AS 16, it will be covered under Ind AS 40. Okay. Then we discussed that recognition criteria. So when an item will be recognized as a property, plant and equipment, then we discussed that if two conditions will be satisfied, one is future economic benefit should be probable and cost can be measured reliably. If these two conditions will be satisfied, then that particular item will be recognized as a property, plant and equipment. And we have seen that this recognition criteria is applicable to initial cost as well as subsequent cost. What is meant by initial cost? Initial cost means the time or the date when you are acquiring a property, plant and equipment. When you are acquiring a fixed asset, for example, you are acquiring a truck, you are purchasing a truck. So this truck is recognized as a PPE if future economic benefit is probable and cost can be measured reliably. So we are aware about the truck because generally the purchase price is known for a purchased item, of course, and the future economic benefit is also probable. When the company will use the truck for transportation of goods, then it will have a future economic benefit. Okay. What is meant by subsequent cost? So we have taken two examples. One is from the institute study material, which is machine and turbine. And the second one is we have discussed about this truck and engine. Okay. So after 5 years, for example, the life of the truck is 10 years. And after 5 years, the company is incurring a major replacement cost or a major repair cost in terms of replacement of an engine. So what is the treatment of that particular engine? So again, we have to see the recognition criteria. Future economic benefits should be probable and cost can be measured reliably. So of course, if the company is replacing an engine of the truck, for example, it will cost around 3 lakh rupees. So cost is known and future economic benefit is also probable because without engine, a truck cannot run. And with the replacement of engine, the truck will run for the next good 3 years or 5 years, or let's say 6 years or 10 years. Okay. So we talked about recognition criteria, initial, subsequent. We discussed about major inspection, major replacement cost. Okay. Then we discussed once an item has been recognized as a property, plant and equipment, after that, at what value it has to be measured. So it has to be measured at cost. And what is the component of cost? The component of the cost is purchase price, including import duties and taxes, plus non-refundable taxes, okay, minus trade discount and rebates, plus directly attributable cost. So we discussed directly attributable cost also. So directly attributable cost means the cost which is directly related to that particular PPE. For example, transportation of machinery, freight cost of machinery, transportation cost of machinery. If the machinery had not been acquired, this freight and forwarding cost would not have been incurred. Okay. So all the directly attributable costs, installation cost, professional fee, assembly cost, these costs are required to be capitalized as a part of the property, plant and equipment. Then we talked about asset retirement obligation. You remember, we have taken an example of Bharti Infratel Limited, Reliance Industries Limited. So site restoration obligation, asset retirement obligation. If the company will have an asset retirement obligation in future due to construction of a particular property, plant and equipment, in that case, estimated cost of property, plant, estimated cost of site restoration obligation or dismantling obligation will be taken at a present value, and that present value will be added to the cost of the asset. Okay, we talked about that this provision will be covered under Ind AS 37, provisions, contingent liability and contingent assets. Then we discussed about that technically if there is a self-constructed asset, there is an acquired asset, it has to be measured at cost. Okay, and cost includes purchase price plus directly attributable cost plus dismantling obligation. Then we talked about if the company is purchasing an asset on a credit basis, then what will happen? Again, it has to be recognized at a or measured at a cash price equivalent. Then we have done an example from the institute study material where it was says that there was a cost of 10 million of a plant, and the cost of 10 million in terms of 3 installments. So we have arrived at a present value. It was 95 lakhs. Okay, it was 95 lakhs. So the difference between total amount paid versus the cash price equivalent will be treated as an interest cost. Okay, and this interest cost will be capitalized if it is a qualifying asset as per Ind AS 23 borrowing cost standard. If it is not a qualifying asset, then this interest cost will go to P&L. Okay, so we discussed all these facts. Okay, now today we are going to discuss exchange of asset concept that I'll take at the last of the standard. Okay, we have covered recognition, we have covered measurement, initial measurement. Now we are covering measurement after recognition. Okay, so once an asset has been recognized, once an asset has been measured at cost, now what will happen at the reporting date? So we are discussing about measurement after recognition. So before that, I believe my audio and video is clear to everyone. So let me look at the queries. If you have any follow-up query with the last class, so I'll take that query. After that, I'll proceed with the next part of this standard. So Ambika is asking, sir, warranty purchased is considered as a separate contract. Why it is not considered as direct cost? Because if I did not purchase that asset, I would not have incurred that warranty cost. So Ambika, you need to see directly, what is the meaning of directly attributable cost? The meaning of directly attributable cost is a cost which is necessary to bring the asset into a condition or to a location necessary for its productivity, necessary for its productive use. For example, I have purchased a car or I have purchased a mobile phone. Okay, so when I'm purchasing a mobile phone, okay, so I have not purchased an insurance or a warranty. I have not purchased a warranty for that particular mobile phone. So even though I have not purchased a warranty for that mobile phone, can I use that mobile phone? Answer is yes, I can use that mobile phone. That mobile phone is good to use. Okay, so it is not a directly attributable cost. It is an incidental cost, or it is a cost which has to charge to P&L. Okay, so you should not deal like this, that if this asset has been purchased, so whatever cost which is going to be incurred on that asset, that will be capitalized, that will not be capitalized. So you have to be very choosy. You have to see what is the cost which is necessary to make this asset productive, to make this asset bringing into a location or bringing into a condition without which it cannot be used. Okay, Ambika, I think you got the answer. So thanks Pujita for confirming. So 5-6 students have confirmed that audio and video is very clear. Thank you very much. Now Ambika is again asking, sir, asset held as rent to others, is it asset to person letting out asset or person to whom it is let out? Asset to person letting out asset, or so Ambika, your query is not clear. Can you again rephrase your query? Again, Ambika is asking, sir, instead of warranty agreement, if it is a maintenance contract, for example, you have purchased a machinery and from the same supplier, you are also entered into an AMC contract, annual maintenance contract. So Ambika, again, these annual maintenance contract will charge to P&L. So these are the costs which are going to incur after the machine is become productive. Okay. For example, Mahindra and Mahindra is selling DG sets. Okay, generators. Okay, so they are also providing maintenance contract. So these maintenance contract are charged to P&L. So then Kostav is asking, sir, in illustration 9, why the maintenance contract is not a directly attributable cost? So Kostav, I have already explained. If inspection cost is incurred, say for example, every 3 years, do we have to calculate PV like we do in case of replacement or dismantling cost? So Kostav, first of all, you need to see why present value is getting calculated. You need to see if we have a cost allocation at the beginning. For example, in my example of a aeroplane or aircraft where we have done for major inspection. So if you remember that particular illustration, so the total cost was 90 lakhs. Okay, and at that time the inspection cost was 5 lakhs. Although the actual inspection cost, which has been incurred after 3 years, was 7 lakhs. But the cost was, but when it was incurred, that time the cost was 5 lakh. So we have segregated it into two parts: aircraft 85 lakhs, inspection component 5 lakh. This 5 lakh has to be depreciated over a period of 3 years. 85 lakh has to be depreciated over a period of life of the aircraft. Okay. After 3 years, this 5 lakh will become zero by fully depreciated, and after 3 years, 7 lakh will be capitalized. Okay. So if you have an initial cost which is there, you are not required to do any present value calculation. But if cost is not there, if it is not there, then you need to calculate what could be the expected cost in the past. So that has to be calculated by way of discounting the current cost. Okay. I hope it is clear, Costa. Okay. Now, so one of the participant is asking for, please explain illustration number 1 of study material. So Ambika is asking, sir, if I hold the asset to let out to others, is it PP to me? So Ambika, first of all, you have to be particular about that asset. If that asset is land and building, okay, then it will not be a PPE. If that asset is land or building, it will not be PPE, it will be investment property. If that asset is other than land and PPE, which is held for rental, then it is a PPE. I have taken an example of vehicle, your crane, your machines. Okay. Remember, I have taken an example of Oryx Corporation. Okay. So now 2 participants are requesting for illustration number 1 of study material. So students, are you talking about illustration number 1, which is deferred payment credit? Are you talking about deferred payment credit, which I have taken in the last class? Please confirm. Are you talking about the deferred payment credit example, which I have taken in the last class? Okay, let's move on. So don't worry. So whatever is left or whatever is not clear to you guys, I'll take that later on. Okay. So now I am moving on to the next concept, which is measurement after recognition. Measurement after recognition. So we have discussed measurement at recognition, and we have discussed that it has to be at cost. Okay. So now we are discussing measurement after recognition. Once the asset has been recognized, then how to measure that asset. So it is more of talking about the reporting period measurement. Okay. So measurement after recognition. For example, I have purchased a car on 7th December, that is today. It is known as an initial recognition. Okay. And what will be the treatment of this particular car on 31st March 21, which is a reporting date, that will be known as a measurement after recognition. Okay. Okay, great. So Nanda, I'll explain that particular illustration one at the end of this session. Okay. So that for the larger audience, because some of the students need to go to office also. So first of all, I will cover all the concept. Then this illustration one I'll repeat at the end of the session. Okay. I think is it perfect to you? Because I have already explained this illustration one in the last class. So measurement after recognition. What is measurement after recognition? So again, it is a measurement of a particular asset which has already been recognized and at the reporting date. So can you tell me what could happen with the asset at the reporting date? What could happen? I'm only talking about the accounting. So we have measured the asset at cost and we have discussed the cost component. Now what will happen at the reporting date? First of all, we need to calculate the depreciation. Am I right? We need to calculate the depreciation. 7th December to 31st March, we need to calculate the depreciation on the car. Am I right? Then probably we need to calculate the recoverable value. We need to see the impairment testing. For example, if the asset is remaining idle, the asset is not giving any productivity. Okay, the demand has been go down. So you need to see if an asset has been, let's say, recognized at or a carrying value of the asset is 10 lakh rupees. So we need to see whether the recoverable value is 10 lakh rupees or not. If the recoverable value is less than the carrying value, then impairment, assessment and impairment loss is required to be recognized. So at the reporting date, first of all, depreciation needs to be calculated. Second, impairment testing needs to be done. Okay. Or what could happen? So these two things will happen on the reporting date. What other? Probably there are two mechanisms of carrying a cost or carrying a value of the property, plant and equipment. One is either we will carry it at a cost or we will do the fair valuation at the reporting date. Am I right? So you all are aware, even in our old accounting standard 10, there was two concepts. One is cost model. The second one is revaluation model. Are you aware about this? Cost model and revaluation model? Are you aware about this? So 3-4 students are saying, sir, depreciation will be charged and it will be recorded at WDV, and if any impairment and scrap value, perfect, Pujita. Ambika is saying at reporting date, depreciation need to be charged. Yes, you all are right. Thanks, Nanda, for confirming. Okay. So friends, cost model and revaluation model, you all are aware because you have read this model in old accounting standard 10 also, which is there in Ind AS 16 also. Okay. But there is a difference between AS 10 revaluation model and Ind AS 16 revaluation model as far as accounting treatment is concerned. I will discuss this part. Okay. So first of all, need to understand what are the different models which is given under this measurement after recognition. So there are two models. One is cost model, and the second one is revaluation model. Revaluation model. So what is meant by cost model? Cost model means you need to calculate the carrying value. Cost model means you need to calculate the carrying value at cost. You need to, what is meant by carrying value? Carrying value means the value at which the asset is carried in the balance sheet. The asset is carried in the balance sheet. Okay. So carrying value means the value at which the asset is carried in the balance sheet, which is reporting date value. Okay. Reporting date value. Okay. Now, under cost model, what is the formula for carrying value? The formula for carrying value CV is equal to CV. What is CV? It is not your resume. It is carrying value. Okay. CV. CV is equal to cost. What is cost? Original cost. Cost minus accumulated depreciation, minus accumulated depreciation, minus accumulated impairment losses, minus accumulated impairment losses, impairment losses. It is not important loss, it is impairment loss, accumulated impairment losses. For example, an asset was acquired on 1st April 2018. A machine was acquired on 1st April 2018 for rupees 10 lakh. Okay. The life of the machine is 5 years. Okay. So calculate the carrying value. Calculate the carrying value of this machine on 31st March 2020. On 31st March 2020. So how to calculate the carrying value of this machine on 31st March 2020 by using the cost model? So what is the original cost? Original cost is 10 lakh. What is the accumulated depreciation? So the life is 5 years. So per annum depreciation is 2 lakh and 2 years have been gone. So 2 lakh multiplied by 2, 4 lakh. So 10 lakh minus 4 lakh. 4 lakh is accumulated depreciation at the end of second year. I am assuming that the recoverable value is more than or equal to the carrying value. So I'm not charging any impairment loss. Okay. Minus 0. So 10 lakh minus 4 lakh minus 0 is 6 lakh. So going by the cost model, 6 lakh is the carrying value. So cost model is very simple. Okay. Cost model is very, very simple. Now we have to move to revaluation model. Okay. So Purushottam is asking, sir, on Saturday I missed your live class, but I watched that class. I have doubt on Saturday class. Can I ask? Yes, you can ask, Purushottam. So Ambika has a very good question. Ambika is asking, sir, if PPE impairment is covered here, then what is the asset which is covered in Ind AS 36? Let me tell you, Ambika. So PPE impairment is not covered under Ind AS 16. It says that wherever impairment is there, it has to be as per Ind AS 36. So the carrying value definition is covered here, and the carrying value is the value at which you need to carry the asset into the balance sheet. And what is that? That is original cost minus accumulated depreciation minus accumulated impairment losses. Okay. And that impairment losses has to be calculated. The recoverable value has to be calculated. The impairment testing has to be assessed as per the requirement given under Ind AS 36. Okay. Perfect. So guys, cost model is pretty simple, very easy, very clear. Okay. So now we are moving to revaluation model. Okay. So I'm removing this cost model part because I need to talk to this revaluation model in detail. Revaluation model. Okay. Now, what is revaluation model? What is meant by revaluation model? Can anyone tell me what is meant by revaluation model? Please tell me what is meant by revaluation model. Friends, what is this revaluation model? I know each one of you is aware about this model. So what is that? What is this model? Guys, let me know. What is this reevaluation model? Okay. So first of all, we discussed about cost model. Now we are discussing the revaluation model. What is revaluation model? It is nothing. It's a fair value. Fair value. Fair value of the asset. Fair value of PPE, property, plant and equipment. Fair value of PPE. Okay. Sir, now how the carrying value has to be calculated on the basis of this revaluation model? So the carrying value has to be calculated on the basis of this revalued model. So what is the formula of carrying value? So the formula of carrying value is again carrying values. Carrying value as per revaluation model is equal to revalued amount minus subsequent accumulated depreciation minus subsequent accumulated depreciation minus subsequent impairment losses. Is it clear? Carrying value as per Ind AS 16 under revaluation model is equal to revalued amount minus subsequent accumulated depreciation minus subsequent impairment losses. Okay. Have you understood? No, don't worry. I'll explain. For example, on 1st April 2018, the company has purchased a machinery. For rupees 10 lakh. The life of the machinery is, the life was 5 years. Okay. The life was 5 years and scrap value is 0. On 31st March 2020, the company has done the fair valuation of that machinery. Okay. The company has done the fair valuation of that machinery and the fair value was 9 lakh rupees. Or let's say fair value was 7 lakh. Fair value was 7 lakh rupees. Okay. So what is the carrying value? First of all, if you are applying the cost model, then the carrying value will be 10 lakh minus 2-year depreciation, 2 lakh minus 2 lakh, 6 lakh will be the carrying value. But here you have applied the revaluation model, and what is the fair value at the end of the second year? It is 7 lakh. So carrying value is 7 lakh. But so this carrying value at 31st March 2020 is 7 lakh. Now what will be the carrying value at 31st March 21? At 31st March 21. So at 31st March 21, the carrying value will be, what is the revalued amount? Revalued amount is 7 lakh minus subsequent accumulated depreciation. So 2 years have been gone. Okay. When this revaluation was done, 2 years has already been gone. 3 years was left. The total life was 5 years. 2 साल खत्म हो चुके हैं, 3 साल बचे हैं. So this 7 lakh has to be divided by 3. So what is the 7 lakh divided by 3? What answer will come? It is around 2,33,000. Am I right? If 7 lakh has to be depreciated in the next 3 years, it is 2,33,000. So revalued amount is 7 lakh. 2.33 lakh is subsequent. Subsequent depreciation. I am assuming impairment loss is 0. So minus 0. So this 7 minus 2.33 is 4.67 lakhs. So this is the carrying value as on 31st March 21. What is the carrying value on 31st March 20? It is, if I will go by the cost model, it is 6 lakh. But I am going for the revaluation model, it is 7 lakh. Okay. Is it clear to you guys? Is it clear to you? Yes, so many students have given the answer of this revaluation. Great, you all are right. So Purushottam is asking, sir, in case of a tractor which is used in the production side, one of the tractor has got damaged. Okay, so one of the tractor has got damaged. Whether the company need to component of PPE recognition, even though cost of tire is low cost as a subsequent recognition. So Purushottam, you have mentioned a very good point. Let me tell you, If I compare the cost of a tire in comparison to the entire tractor, so the cost of the tire is very low, could be 3,000 and 4,000 as far as the cost of the tractor is concerned. So it will not be considered as a major replacement or a major repair. It will be considered as a day-to-day cost, or it will be considered as a consumable cost, or it will be considered as a servicing cost kind of thing. So it will be charged as a repair and maintenance cost in profit and loss. It is not a major replacement cost. Please remember, the word used in the standard is major inspection, major replacement. Okay, so major repairs. So that will be covered. This cost of tire could not be considered as a cost of the is not considered a subsequent cost, which has to be capitalized as a Ind AS 16. Okay. Okay, great. So friends, we discussed about this aspect, carrying value under cost model and carrying value under revaluation model. So carrying value under revaluation model is revalued amount minus subsequent. I am talking about subsequent depreciation. Once the company has done the revaluation, the revalued cost will become the cost of that particular asset. The revalued cost, the revalue cost will replace the original cost. Okay, and the prospective depreciation will be charged to the remaining useful life of the asset. So that is why the word is subsequent accumulated depreciation, subsequent impairment losses. Okay, perfect. Should I move on? Okay, now revaluation model. Okay, now sir, the question arises, sir, whether company can do the revaluation of a particular asset. Can the company do the revaluation of a particular asset? Question number 1. Please remember, the revaluation has to be done for a class of asset. The concept of class of asset. What is the concept of class of asset? Class of asset means the asset, the number of asset or asset which is having a similar use and similar purpose for that company. Similar use and similar purpose for that company. Okay. So for example, a company has a factory building. So company has a factory building. So there is a textile company which has 3 buildings, 3 factory buildings, 3 factories. One is at Bhilwara, the second one is Coimbatore, and the third one is in Bangalore. Bangalore, Bhilwara, and Coimbatore. And the company wants to do the fair valuation of only a Bangalore property, only a Bangalore factory building, but does not want to do the fair valuation of Bhilwara and Coimbatore factory building. Can the company is allowed to do so? Can the company is allowed to do so? I want a quick answer. Remember, I have told you last time, I have told you, the more you interact, the more you learn. The more you participate, the more you earn. As simple as that. So my question is, the company has 3 factory building and the company wants to do the fair valuation of only a particular Bangalore factory building and does not want to do the fair valuation of Bhilwara and Coimbatore factory building. Can the company do so? Is it allowed under Ind AS 16? Is it allowed? Because the Bangalore factory building price has been increased substantially, but Bhilwara and Coimbatore could be decreased or could be on the similar lines. So company don't want to do the fair valuation of those particular factory buildings. So whether cherry pick choice is there? Answer is no. Answer is no. Cherry pick choice is not there. Cherry pick choice is not there. If the company is doing the fair valuation of a particular asset, then entire class of asset is going to be fair valued. Then the entire class of asset is going to be fair valued. What is meant by class of asset? Yes, Pujita, you're right. What is meant by class of asset? A grouping of assets of a similar nature and use in the entity's operation. What, sir, what could be the example of class of asset? Factory building, land, office building, vehicle, furniture and fixtures, okay, plant. So these are the examples of class of asset. So class of asset means grouping of asset of a similar nature and use in the entity's operation. Whether factory building and office building are same class of asset? Answer is no. Factory building and office building are a separate class of asset. Okay, factory building and office building are the separate class of asset. Factory building has different use, office building has a different use. Okay, so grouping of asset of a similar nature, and use in entities operation. Factory building is used for production. Okay, and office building is used for administration. So there is a different use. Okay, so these are two different class of asset. So a company wants to do the fair valuation of all the factory building, but does not want to do the fair valuation of office building. Is it allowed? Yes, it is allowed, because the fair valuation has to be done by a class of asset. If one asset is going to be fair valued, then that particular entire class is going to be fair valued. The company cannot have a cherry pick choice. Okay, is it okay? Great. Let me see if there is any query. Yes, Vaibhavi, you are right. Vaibhavi is saying, no, sir, company cannot do only Bangalore factory building fair valuation. It has to be as per the entire class of asset which is given under the standard. You are right, Vaibhavi. Yes, Pujita, you are also right. Ambika, you are also right. Wonderful students, I would say, wonderful guys. You all will score more than 80% marks in your financial reporting. Rather, I would say this. Yes, revaluation model. So we discussed this concept of class of asset: factory building, office building, land, machinery, aircraft, ship. Okay, so these are known as a class of asset. Furniture and fixtures, plant, these are known as a class of asset. Okay. Second concept, sir, we understood that one asset, if one asset is fair valued, then that entire class is getting fair valued. Okay. Sir, whether fair valuation has to be performed every year, whether fair valuation or revaluation needs to be performed at every year end. What will your answer? What will be your answer? Whether valuation needs to be performed at every year end or at every reporting period? Answer is no. Valuation need not to be performed at every year or at every reporting period. Okay. If the difference between the cost and fair valuation is minimal or is not substantial, it's not significant. But if it is significant, then yes, it has to be performed at a regular intervals or at least at a every year end. Okay, it has to get sufficient regularity. So fair valuation need to be done at sufficient regularity. For example, if the real estate market is highly volatile, okay, and the company has opted the revaluation model for its office building, factory building, in that case, if the changes are significant, I mean to say fair value versus cost is material. If it is significant, then it is, yes, it could be at every year. Okay. But if changes are not material, for example, the real estate market is stable. If we look at the real estate market in Gurgaon or in Delhi NCR, so I remember the real estate market is at surge from 2004 to 2012. Okay, so if you look at the prices from 2004 to 2012, the prices were increasing rapidly. But after 2012 or 2013, the market becomes stable. I mean to say, the prices are not moving in comparison to what it was in 2004 to 2012. Okay, so if the fair valuation difference between fair valuation and cost or fair valuation and carrying value is not significant, then the fair valuation can be performed at an interval of 3 to 5 years. Okay, at a 3 to 5 years, because this fair valuation need to be done through a valuer, which will incur a cost. Okay, so standard says that it has to at a sufficient regularity. Okay, if the movement in fair value are highly volatile and significant, then you need to go for regular intervals. Otherwise, 3 to 5 years are more than sufficient. Okay, is it okay? So Ambika is asking, sir, in case of fair value revaluation, WDV is replaced by revalued amount on the date of revaluation. Yes, Ambika, you are right. Like in my example of 7 lakh, you remember on 31st March 2020, if we would have go by the cost model, it was 6 lakh. But the date on the date of revaluation, the amount was 7 lakh. So we have on by calculating the carrying value on 31st March 21, we have taken the opening value of 7 lakh. Okay. Is it okay? So Purushottam is asking, sir, in case of construction companies construct a temporary building at site for administrative purposes, is that companies required to maintain or recognize the ARO SRO for dismantling of that building after that construction period is over? So yes, Purushottam, if the ARO cost is significant, yes, you need to maintain that. Okay. So Purushottam is asking, sir, I have further doubt in my tractor tire example. As per para 13 of India 16, it talks about replacement at regular intervals. Such cost also be capitalized if recognition criteria is met. In my opinion, it should be capitalized per my opinion. Please explain. So Purushottam, see, you need to see the two things. Okay. If I talk about the servicing, so whether servicing is required at regular intervals, answer is yes. If you have purchased a car, the car requires a regular servicing cost even after expiry of 5,000 kilometers or after expiry of 6 months or 1 year. Okay. Is it necessary to get the servicing done? Yes, it is necessary to get the servicing done. Without servicing, can you continue running the car? Is it required to maintain the car? Answer is yes. If you will not do the servicing, you cannot run the car. After a certain period of time, the car will not be able to run, or the car will not be able to, to work properly. Now the thing is, whether future economic benefit is probable, answer is yes. Cost can be measured reliably, answer is yes. And is it required in regular interval? Answer is yes. So do we need to capitalize every single penny? Do we need to capitalize every single penny in relation to that asset? Answer is no. You need to take a very wise call. Is it a significant amount? Is it an amount significant to the total cost of the asset? Is it a significant part? Is it a significant component? So you need to see that. Okay. And you need to create at least a maturity level for your asset. Otherwise, it would be very difficult for changing our cost of the asset again and again and depreciating it again and again on the basis of the revised cost. Okay. So the thing is, if you're replacing a tire, you need to see. I understand that this tire will require to be replaced at after 4 years, 5 years, or after a certain kilometers, like 40,000 kilometers, 50,000 kilometers. So you need to see, is it a significant cost? If it is a significant cost, you need to go for it. If it is not significant, you should not require to go for it. Okay. So in my opinion, for example, the cost of the car is 10 lakh rupees. So generally the cost of the tire is 5,000 rupees per tire, hardly. Okay, it's 4,000 or 5,000. So the entire cost of the tire is 20,000 to 25,000 rupees for a 10 lakh rupees car. So it is not significant. It is hardly 20,000 rupees is hardly how much percent? How much percentage? It is hardly 2%. Hardly 2% of the entire cost of the car. So it is not considered as a significant cost. Okay, so you can charge off it to the P&L. Otherwise, it would be very difficult to track the cost of a particular item of PPE. Okay, so nothing would go into the P&L if you will only focus on future economic benefit. Probable cost can be measured reliably. So you need to see, is it a major cost? Is it a major replacement, major overhauling, major inspection? Then it is okay, otherwise not. Understood, Purushottam? Okay, great. So friends, we discussed about this revaluation model. We talked about carrying value. We talked about class of asset. We talked about the interval of the fair valuation. So now I am moving on to the very, very important part of the treatment of fair valuation. Before that, I'll take you through with a particular example of which is given under the institute study material. Illustration number 4 at page number 7.44. So let me show you the study material here. Are you able to see this study material which is there on the screen? Illustration number 4. Venus Limited is a large manufacturing group. It owns a considerable number of industrial buildings such as factories and warehouses and office buildings in several capital cities. The industrial buildings are located in industrial zones, whereas the office buildings are in central business district of the cities. Venus Limited management wants to apply the Ind AS 16 revaluation model to subsequent measurement of the office building, but continue to apply the historical cost model to the industrial building. Is this acceptable under Ind AS 16 property plan and equipment? Friends, tell me what is your view on this? What is your view on this? Guys, please respond quickly. So the company is a large manufacturing group and they have a lot of industrial building like factory and warehouses, and they have office building also in various cities. So the company wants to apply revaluation model to the office building, but does not want to apply the revaluation model to industrial building. So is this acceptable treatment under Ind AS 16? Is it acceptable or not? The company needs to apply this revaluation model. The company needs to apply this revaluation model to both the class of asset. I mean to say, it also has to apply this revaluation model to industrial building. What is your view? So Chavi is saying some management can apply because it's different from industrial building. Ambika is saying yes sir, it is acceptable because it is a different class of asset. Okay. Preeti is again saying the same answer. Yes, it is possible. Kaustav is saying yes sir, it is acceptable because office building and industrial building are different class of asset. Yes, you are right. Now quickly, just for summarizing or just for recapping or revision, I'm reading the solution. Venus Limited management can apply the revaluation model only to the office building. The office building can be clearly distinguished from the industrial building in terms of their function, nature, and use in the entity's operation and the general location. Ind AS 16 permits asset to be revalued on a class by class basis. The different characteristics of the building enable them to be classified as different PPE classes. The different measurement model can therefore be applied to these classes for subsequent measurement. All properties within the class of office building must therefore be carried at revalued amount. Separate disclosure of the two classes must be given in accordance with para 73 of Ind AS 16. The question is, sir, whether we need to do any disclosure? Yes, we need to provide a disclosure in the notes to account that we have applied the revaluation model for office building and we have continued with the cost model for the industrial building. The disclosure is required. Okay, perfect. So now I am again moving to the whiteboard. So I'm unsharing the screen. So we have discussed class of asset part. We have discussed the regular intervals. We have discussed the revaluation intervals. So when the revaluation is required to be done, on which asset revaluation is required to be done, how to, in case of revaluation, how to calculate the carrying value of the asset. Okay. So now I am shifting to the most important and significant part of treatment of revaluation. Treatment of revaluation accounting. Okay. So I'm removing all this stuff which is there on the whiteboard. Please listen carefully. Okay. For example, on 1st April 2018, on 1st April 2018, the cost of machine is 10 lakhs. The cost of machine is 10 lakhs. Okay. On 31st March 19, so again, the life is 5 years. Okay. So on 31st March 19, the company has opted for revaluation. Revaluation has been done, and on 31st March 2019, the fair value was 9 lakhs. The fair value was 9 lakhs. Okay. On 31st March 20, again the revaluation has been done. On 31st March 20, again the revaluation has been done, and on that date, the fair value was 9427. The fair value was 6 lakh. Okay. Have you got the question? On 1st April 2018, the cost of the machinery was 10 lakh. Okay. The life was 5 years. I'm assuming scrap value is 0. On 31st March 2019, the company has opted for revaluation, and the fair value was 9 lakh. On 31st March 2020, again the company has done the fair valuation, and the fair value was 6 lakh. So advise the accounting treatment. So now what is the question? The question is advise the accounting treatment. Advise the accounting treatment in FY 18-19 and 19-20. FY 18-19 and 19-20. So we need to advise the accounting treatment in FY 18-19 and 19-20. Okay. So this is the question. So now I am explaining the concept. So what is the concept? So Purushottam is asking, sir, the company is required to measure the fair value at each reporting period for revaluation model, or else company should stand by the cost model is enough. Purushottam, there are two models which is given under the standard. Okay, cost model or revaluation model. It is a choice of the company. If the company has opted for revaluation model, then the company needs to see, is there a significant movement between the fair values at every reporting date? If the movement is volatile, highly volatile, the rates are changing rapidly, in that case, revaluation or fair valuation is required at least once in a year. Almost it is required at every reporting date, or rather I would say at a regular sufficient intervals. But for example, the company has done the fair valuation in the first year or second year, and the prices are not significantly volatile. The prices are not changing significantly. So the hardly changes 5% or maximum 10%. So in that case, the company should continue with the last revaluation amount. The company should continue with the last revaluation amount after charging the depreciation. Okay. So 3 to 5 years is sufficient in that case. And after 3 to 5 years, the company can do the fair valuation or revaluation again. Okay. But if the movement is volatile, highly significant, in that case, every year the revaluation is required. Okay. So now we need to discuss the accounting treatment in 1819 or 1920. So first of all, I'll explain the concept. In case of revaluation, if it is increase, if it is an increase, in case of revaluation, if it is an increase means increase in the value of the asset. Okay. So the cost of the asset was 5 lakh. The company has done the revaluation and it is 7 lakh. Okay. Now what will be done? If there is an increase in revaluation surplus, then that increase will go to OCI. Then that increase will go to other comprehensive income. Have you heard about the concept of other comprehensive income in India? Is one other comprehensive income, revaluation surplus. So if there is an increase, it will known as a revaluation surplus. So this revaluation surplus will go to OCI. And what will be the accounting entry? The accounting entry will be asset account debit to revaluation surplus or other comprehensive income, OCI. Have you heard about the OCI concept? If there is an increase, then the revaluation surplus will go to other comprehensive income. Okay. Okay. Sir, for example, the increase was in the first year. Okay. The increase was in the first year, and in the next year there is a decrease. For example, the cost of the asset was 5 lakh. 5 lakh was the cost, and in the first year it becomes 7 lakh. Then where this 2 lakh will go? This 2 lakh will go to other comprehensive income. So here 2 lakh will go to other comprehensive income. Okay. Asset account debit 2 lakh to other comprehensive income 2 lakh. In the second year, so just for the sake of explaining the concept, I am not charging any depreciation here. Okay. Just for the sake of explaining the concept. The cost was 5 lakh. At the end of the first year, the fair value was 7 lakh. So 2 lakh has been recognized, credited in other comprehensive income reserve, revaluation surplus, other comprehensive income. It has to be routed through OCI. Okay. In the second year, the value become 4 lakh. For example, the value become 4 lakh. Then what will happen? So there is a decrease. Subsequently, there is a decrease. So first time there was an increase. Subsequently, there is a decrease. Then what will be the treatment of a decrease? What will be the treatment of decrease? What will be the treatment of decrease? So here, standard says that to the extent amount is lying in the revaluation surplus, or to the extent amount has been credited to revaluation surplus, it has to be debited there. So here, what is the loss? 7 lakh minus 4 lakh. What is the total loss? 7 lakh minus 4 lakh, 3 lakh. Okay. So there is a decrease of 3 lakh. And out of this decrease, 2 lakh should be debited to OCI. 2 lakh should be debited to OCI, and 1 lakh should be charged to P&L. And what will be the accounting entry? Revaluation surplus OCI account debit 2 lakh, P&L account debit 1 lakh to asset account 3 lakh. Okay. So remember, when there is a first time increase, we have credited our revaluation surplus, other comprehensive income. But when there is a subsequent decrease, the subsequent decrease is required to be adjusted to the extent the company is having a credit in the revaluation surplus account. Okay. So we have debited OCI by 2 lakh. We have debited loss on revaluation P&L by 1 lakh, and we will credit asset by 3 lakh. So this is a concept of revaluation surplus treatment, accounting treatment. Okay. Is it okay? Sir, what will happen? For example, instead of this in the second year becoming it 4 lakh, it become 8 lakh. Then what will happen if there is a subsequent decrease? If there will be subsequent decrease, again it will go to other comprehensive income. So the accounting entry will be again asset account debit to revaluation surplus OCI account. Okay. Sir, what will happen if first time there is a decrease? For example, here the cost was 5 lakh. And in the first year it become 4 lakh. And in the second year, so this is the cost. This was first year. In the second year it becomes, let's say, 6 lakh. Then what will happen? So standard says that if there is a first time decrease, the decrease will go to P&L as an impairment loss. If first time there is a decrease, it will go to P&L. It will route it through profit and loss. It will go to P&L. Okay. So Usha, your query is not clear. So Purushottam, I have replied to all your queries. So if you have not got the answer or I missed your query, please repeat your query again. So guys, in case of decrease, first time decrease, it will go to P&L. Okay. So in my example, 1 lakh will go to P&L. What will be the accounting entry? The accounting entry will be impairment loss P&L account debit to asset account. And subsequently there is an increase. Then what will happen? So in this question, this 4 lakh becomes 6 lakh. This 4 lakh becomes 6 lakh. Then what will happen? So standard says that to the extent of debit to P&L, we need to credit the P&L. Okay. So we already have debited P&L by 1 lakh and there is an increase of 2 lakh. So in this case, 1 lakh should be credited to P&L, 1 lakh should be credited to P&L, and 1 lakh will go to OCI. 1 lakh will go to OCI, other comprehensive income. What will be the accounting entry? Asset account debit 2 lakh to P&L impairment loss reversal 1 lakh to revaluation surplus OCI 1 lakh. Okay. So this is the accounting treatment. This is the accounting treatment of revaluation surplus. Okay. If there is a first time increase, it will go to revaluation surplus OCI. If again it is an increase, again it is go to OCI. If subsequently it is a decrease, to the extent increase is available in OCI, we need to set off that increase. Okay. So this is the overall scenario for accounting treatment of revaluation surplus. Great. So 4-5 students have confirmed that they have understood the concept of treatment of revaluation surplus. Now I'll solve again for the purpose of revision. I'll solve this question, which is there on your whiteboard. Now you need to tell me the accounting treatment in financial year 18-19 and 19-20. So I'll not tell. I'll not solve. You need to solve. In the 1st April 2018, the cost of the machine was 10 lakh. Life is 2 years. On 31st March 19, the revaluation amount is 9 lakh. On 31st March 20, the fair value or revaluation is 6 lakh. So what is the accounting treatment in financial year 18-19? Financial year 18-19. First of all, in financial year 18-19, you need to calculate the WDV. First of all, calculate the WDV. Calculation of WDV as at 31st March 2019. So what is the WDV? 10 lakh is the cost. What is the carrying value? 10 lakh minus what is the depreciation? So 10 divided by 5, 2 lakh minus 2. So what is the WDV? WDV is 8 lakh. So carrying amount is 8 lakh. And what is the revalued amount? So revaluation amount is 9 lakh, which is given in the question. 9 lakh. Okay. So revalued amount. So this is the WDV. Now point number 2. What is the fair value? Fair value is 9 lakh. So is it a revaluation increase or decrease? Is it an increase or decrease? So the carrying value is 8 lakh, revalued amount is 9 lakh, so there is an increase. So what will be the accounting entry? The accounting entry will be The accounting entry will be machine account debit, machine account debit 1 lakh to revaluation surplus other comprehensive income 1 lakh. This will be the accounting entry. Okay, this will be the accounting entry. So what will happen in 2019-20? So this was 18-19, financial year 19-20. In the financial year 19-20, first of all, calculate the WDV. Calculate WDV on 31st March 20. So what will be the WDV on 31st March 20? What is the opening value? What is the opening value? The opening value will become 9 lakh. Am I right? The WDV of 8 lakh will be replaced by 9 lakh. Am I right, Ambika? Am I right, Purushottam? Pujita, Chavi, Nanda? Okay. So here the opening value was 9 lakh. Now what is the depreciation? What is the depreciation? The total life was 5 years. 1 year has already been completed, and the opening value is 9 lakh. So this 9 lakh has to be depreciated over a period of remaining life, which is 4 years. So 9 divided by 4. 9 lakh divided by 4. What is the answer? What is the depreciation? 9 divided by 4. 4 2s are 8, and it is 2.25. Am I right? 2.25 lakh. Yes, 2.25 lakhs. 2.25 lakhs. So what is the WDV? What is the WDV? 9 minus 2.25, 6.75 lakhs. Is the WDV correct? 6.75 lakhs. Is it the correct WDV? Is it the correct WDV? 6.75 lakhs. Is it the correct WDV? 6.75 lakhs. Okay. Now, what is the second point? What is the fair value on the reporting date? The fair value is 6 lakh. So how much decrease is there? 6.75 minus 6. How much decrease is there? Decrease. How much decrease is there? How much loss is there? 6.75 minus 6. The loss is 0.75 lakhs. 0.75 lakhs. So what is the treatment of 0.75 lakhs? What is the treatment? You need to see whether the revaluation surplus is available in OCI. Yes, it is available by 1 lakh. Remember, last year we have credited 1 lakh in OCI. You remember? Last year we have credited 1 lakh in other comprehensive income. Okay. Okay. So in that case, what will be the accounting entry? The accounting entry will be revaluation surplus. OCI will be debited by 0.75 lakhs to asset account 0.75 lakhs. Okay. So by 0.75 lakh asset will be credited. Okay. Is it okay? So what is the carrying value of the asset? The carrying value of the asset is 6 lakh. The carrying value of the asset is 6 lakh. Any doubt? Ambika, you're right. 0.75 debit to revaluation surplus OCI, credit to PPE asset, credit to machine. Okay. Should I remove this? So Vaibhavi is asking something. As on 31st March 19, WDV is equal to 8 lakh and increase in fair value is by 1 lakh, which will goes to revaluation surplus. In FY 1920, depreciation on 9 lakh for 4 years is 2.25 lakh. Hence, WDV is 6.75 lakh. Revaluation surplus is to be reduced by rupees 75,000. Thank you, everybody, for summarizing this concept or summarizing this question. Purushottam is saying, while calculating the depreciation, why should not we go for retrospective instead of prospective effect in our example question effect? Purushottam, please remember, although I have to come on that in the subsequent part when I will be discussing depreciation. So change in depreciation, change in useful life, okay, change in carrying value, these will be considered as a change in estimate. I hope you guys have completed Ind AS 8 accounting policies, accounting estimate and correction of errors. Okay, so this will be considered as a change in estimate and it has to be applied prospectively as per Ind AS 16 and Ind AS 16 and Ind AS 8. Okay, so Ind AS 16 specific says that change in useful life, change in depreciation, so these will be considered as a change in estimate and needs to be applied prospectively, not retrospectively. Okay. Purushottam, I think I have given your answer. Yes, Ambika, you're right. On 31st March 2020, the balance in OCI is 0.25 lakhs. Okay. Now I'm moving to the next concept of again this revaluation surplus. Sir, what is the so we understood so far that what will be the treatment of revaluation surplus, increase or decrease. Now, sir, if that revaluation surplus is lying at the end of the at the end when the asset is getting derecognized, then what will happen with this revaluation surplus? Okay, or how this revaluation surplus will be utilized. For example, there is a revaluation surplus and there will not be any decrease. Then how this revaluation surplus will be utilized? Okay. So Kaustav is saying, sir, first depreciation has to be charged. After that, revaluation has to be given effect. Am I right? Yes, Kaustav, you're right. Okay. Now, utilization of revaluation surplus. Utilization of revaluation surplus. Revaluation surplus. So there are two things for utilization of revaluation surplus. First, when asset is derecognized. When asset is derecognized. Means when there is an end of the lifetime of the asset. Okay. So there was an asset which is getting discarded or sold out. Okay. So the company has purchased a machinery for rupees 10 lakh. The WDV was 8 lakh. The company has done the revaluation and the revaluation surplus was 2 lakhs. Okay. And in the next year, the company has sold out the asset. Okay. So this revaluation surplus is existing for rupees 2 lakh. So when the asset is derecognized, then this revaluation surplus will go to retained earning. What will be the accounting entry? Revaluation surplus account debit to retained earning. To retained earning. So standard says that this revaluation surplus will not transfer to P&L. This revaluation surplus will directly transfer to retained earning, reserve to reserve. What is this revaluation surplus? What is OCI? Other comprehensive income is like a reserve. Okay. So standard says that it will not be routed through P&L. This revaluation surplus will be debited and retained earning will be credited. Okay. So when the asset is derecognized, whatever balance was lying in revaluation account in your other equity or in your reserves, it will transfer to retained earnings. Okay. It goes to equity. Yes, Pujita, you're right. It goes to equity. Okay. Great. Now, the second concept could be when the asset is getting used, when the asset is used. So first I'm talking about the end of the life of the asset. I mean to say end of the journey of asset, or the asset could be sold out to the other person. Okay. Now I'm talking about if the asset is getting used. So asset is used. asset is used, then what will happen? So I'll explain this concept with the help of example. For example, the cost of the asset is 10 lakh. Okay, and life of the asset is, cost of the asset is 10 lakh, and the life of the asset is 10 years. Cost is 10 lakh, life is 10 years. What is the per annum depreciation? Depreciation will be 1 lakh. Okay, so the company has done the fair valuation. Okay, so by doing the fair valuation, let's say it become 12 lakh. The cost become 12 lakh. I mean to say, sorry, the fair value is 12 lakh. So the value of the asset will become 12 lakh. And according to 12 lakh, what is the depreciation? For example, life is 10 years only. Then what is the depreciation? If the value is 12 lakh, life is 10 years, then what is the amount of depreciation per year? What is the amount of depreciation per year? Purushottam, what is the amount of depreciation per year? Please reply. It will be 1.2 lakh, 1.20 lakhs. It will be 1.20 lakhs, 1,20,000. Is it okay? Guys, I'm only getting a response of 5-6 students. What about Chavi, Preeti, Ambika, Purushottam, Kaustav, Vaibhavi? Okay, great. So going by the original cost, the depreciation was 1 lakh. Going by the fair value, the depreciation is 1.2 lakh. Okay. So how much depreciation have been increased? 20,000 per year. How much revaluation surplus have been increased from 10 lakh? It become 12 lakh. So what is the revaluation amount? What is the revaluation surplus? The revaluation surplus is 2 lakh. The revaluation surplus is 2 lakh. Okay. So standard says that whatever excess depreciation is there on account of revaluation, first of all, you have to debit the entire depreciation in your P&L. Okay. So this 1.2 lakh every year will be debited to profit and loss account. Is that okay? Answer is yes. Standard says that every year you can transfer your revaluation surplus to the retained earning to the extent of excess depreciation. What is the excess depreciation? So excess depreciation is equal to depreciation on revalued amount minus depreciation on original amount. So what is the excess depreciation? Depreciation on revalued amount minus depreciation on original amount. So what is this? 1.2 lakh minus. So what is the excess depreciation? 1.20 minus 1 lakh. So 20,000 is excess depreciation. 20K is excess depreciation. So what is the accounting entry every year? So every year the accounting entry will be revaluation surplus reserve debit by 20,000 to retained earning 20,000. Okay. Is it clear to you guys? Is it okay? Or not okay? Any challenge? So Purushottam, technically speaking, there is no any concept of gross carrying amount. There is a concept of gross block or original cost. So carrying amount concept is there. Carrying amount means original cost minus accumulated depreciation minus accumulated impairment loss. Okay. So gross block means original cost or revalued amount. So friends, now I am sharing my PPT. Please confirm if it is visible to you guys. Are you able to see the PPT? In the PPT, you can see so there is a first time increase, it will go to revaluation reserve OCI. If there is a first time decrease, it will go to P&L. Okay. If there is a first time increase and it has gone to revaluation reserve OCI, and if there is a subsequent increase, again it will go to OCI. But if it is a subsequent decrease, it has to be first adjusted from revaluation reserve OCI, then excess has to go to P&L. Okay. So over and above that decrease will go to P&L. But if it was a first time decrease, it goes to P&L, and then it is an increase. So first you need to reverse the decrease in P&L, and then you need to credit your OCI if it is over and above. So first time there was a decrease, again there was a decrease, it will go to P&L. So we have done this with the help of two examples. One, when I was using for explaining the concept. Second, I have used a complete example with the help of calculation of WDV. Transfers from revaluation surplus to retained earnings are made in following circumstances and are not made through profit or loss. I have told you the accounting entry is revaluation surplus debit to retained earning. It's a balance sheet to balance sheet entry. When the asset is derecognized and when the asset is used. So when the asset is used, difference between depreciation based on revalued carrying amount and asset original cost. Okay. Is it okay? So friends, this ABC Dynamics Limited, so answer is also there. I have already covered this concept in my last two examples. Okay, in the last two examples. So now I am moving on to one more important concept. So Rohita is saying, sir, depreciation on fair value of 12 lakh. Sir, depreciation on fair value of 12 lakh is to be done for 9 years as 1 year completed, but we have done for 10 years. Why? So Rohita, I have used this just to explain the concept. Okay, just to explain the concept that the excess depreciation is 1.2 lakh. But otherwise, if it is at the end of the year, you are doing a revaluation at the reporting date. Of course, this 2 lakh. So there is an increase of 2 lakh. There is an increase of 12 lakh. So basically, you need to calculate the WDV at the end of the first year. The WDV was 9 lakh. Then you need to compare the amount with the fair value amount, which is 9 lakh versus 12 lakh. It was 3 lakh. Okay, it was 3 lakh. So now, if you would have continued with the depreciation on the basis of original cost, it was 1 lakh every year. But going by the 12 lakh divided by 9, it was increased. So 12 lakh divided by 9, it was increased by how much amount? So 3 lakh divided by 9, how much amount? It is around 35,000. Okay, 30 or 35,000. So that 35,000, that excess has to be go to the retained earning over a period of 9 years, so that 3 lakh will be completed or exhausted. Okay, so just I have to explain the concept that how this revaluation surplus will be utilized when the asset is getting used. Okay, Rohita, is it clear to you? Otherwise, the concept is calculate the WDV at the reporting date, compare the WDV with the fair value. Okay, so whatever excess or less is there, it will go to OCI or it will go to P&L. Okay, if it is going to OCI as a revaluation surplus, then you need to do the two treatment. One, if the asset will be derecognized and transfer the entire amount on the date of derecognition to the retained earning. If the asset is getting used, in that case, you need to see what is the excess depreciation. What is the formula of excess depreciation? Depreciation on the revalued amount, which has to be or charges which has to be charged in future, versus depreciation on original amount. So the difference will go to retained earning every year. Revaluation surplus to retained earning. Okay. Rohita, is it okay? Great. Okay, so now I am moving on to the next concept of. So we discussed this revaluation concept. Now we discuss the treatment of accumulated depreciation. So we talked about the treatment of revaluation surplus. We talked about the utilization of revaluation surplus. We talked about the class of asset. We talked about the frequency of the revaluation. Okay. Now we are discussing first of all, you all are aware these concepts in case of fixed asset. Gross block, accumulated depreciation. Okay. Then there is a net block. We all are aware about this. For example, there is a gross block of 1 lakh rupees, which is technically a cost or revalued amount. Okay. Accumulated depreciation means the total depreciation till the reporting date. For the first year, it is first year depreciation. For the second year, it is 2-year depreciation. For third year, it is 3-year depreciation. For example, accumulated depreciation is 60,000. Then what is the net block? Net block is 40,000. So we all are aware about this concept. Okay. Now standard says that in case of revaluation, okay. So how to treat the carrying amount? In case of revaluation, how to treat the carrying amount? What is the carrying amount? Carrying amount means cost minus accumulated depreciation minus impairment losses. So standard says that in case of revaluation, for example, we have seen in our example, after the WDV, we have calculated WDV, and there is an increase in WDV. Okay. So how to do the adjustment in such case? Sir, we didn't understood what you are saying. Okay. For example, this is a gross block of 1 lakh. This is the accumulated depreciation of 60,000. This is a net block of 40,000. Now, the fair value on the date of revaluation is let's say 60,000. Is 60,000. So what I need to do? Should I directly add this 20,000 to the cost of the asset, or do I need to increase the gross block, increase the accumulated depreciation so that this net block will become 40,000? So what do I need to do? The standard says that there are two approaches. The standard says that there are two approaches for adjusting the fair valuation into the net block. For adjusting the fair valuation into the net block, which is WDV. So what are the two approaches? The first one is gross approach. Gross approach. What is the gross approach? Standard says that in case of gross approach, you have to restate your gross block and accumulated depreciation so that your net block will become your fair value. Okay. What does it mean? Please write down. In case of gross approach, restate gross block and accumulated depreciation so that net block is equal to fair value. Okay. Sir, how to do this? Sir, how to apply this concept in case of gross approach? So friends, what is the gross block here? 1 lakh. What is the accumulated depreciation here? 60,000. What is the net block here? 40,000. And what is the fair value here? 60,000. So you need to calculate the percentage increase. What is the percentage increase in comparison to net block? In comparison to net block. What is the increase in percentage in comparison to net block? Please tell me. Please tell me. What is the percentage increase? So what is the increase? 60,000 minus 40,000, 20,000. Okay. So 20,000 divided by 40,000. So there is an increase of 20,000. Am I right? So the net block, the carrying value was 40,000. The fair value is 60,000. So what is the increase? It is 20,000. And what is the percentage of increase? It is 50%. So 20,000 divided by 40,000, it is 50%. It is 50%. Okay. So in that case, standard says that going by the gross approach, you need to restate your gross block and accumulated depreciation so that net block is equal to fair value. So in this case, we need to debit the asset. We need to debit the asset. I mean to say gross block. Debit the gross block of the asset. Debit the asset by how much amount? By 50% of the original cost. What is the 50%? It is 50,000. Okay. It is 50,000. And we need to credit the accumulated depreciation. How this 50,000 has come? So it is 1 lakh multiplied by 50%. Then credit to accumulated depreciation. So we are restating this accumulated depreciation again by 50%. What is the accumulated depreciation here? It is 60,000. So 60,000 multiplied by 50%. How much it will come? 30,000. 30,000. So we have debited 50,000. We have credited 30,000. So what is the difference? Difference is 20,000. 2. This difference will go to revaluation surplus. To revaluation surplus OCI. 20,000 credit. This is the balancing figure. Guys, is it okay? Is it okay? So going by the gross approach, just to effect, going by the gross approach, Purushottam, it is not 20%, it is 50%. Increase is 20,000. So 20,000 divided by 40,000 will give you 50%. Okay. So going by the gross approach, you need to gross up your gross block as well as your accumulated depreciation so that your net block will become is equal to fair value. So now what is the total gross block? We have debited 50,000. So gross block will become 1,50,000. We have credited debt by 30,000. So your accumulated depreciation will become 60 plus 30, 90,000. So 1,50,000 minus 90,000 is equal to 60,000. So in this case, what is the carrying amount? Your carrying value is equal to gross block minus or cost minus accumulated depreciation. So in this case, the total gross block become 1.5 lakh minus 90,000, 0.9 lakh. So this becomes 60,000. See, this was your fair value. 60,000. This was your fair value. Is it okay? Guys, are you clear on this? Guys, are you clear on this? Any challenge so far in this gross approach? Very simple. Ambika, are you clear on this? Gross approach? Please respond so that I'll move ahead. Very simple. So gross approach means grossing up your gross block and your accumulated depreciation. Okay. Yes. Okay. Now, what is meant by the net approach? Now, what is meant by net approach? What is meant by net approach? So I am removing this gross approach. So what is meant by net approach? Net approach means eliminate existing egg debt. Eliminate existing egg debt. Okay. Eliminate existing egg debt. So in this case, if we will eliminate existing egg debt, so what will be the value of the asset? So we will do an accounting entry, egg debt account debit, accumulated depreciation account debit. By how much amount? The total egg debt is 60,000. See, the total egg debt is 60,000 to asset account. To asset account. 60,000. Now, what will be the balance of asset? Now, what will be the balance? What will be the balance in the asset account? Balance in asset account. What will be the balance in asset account? If we have removed this 60,000 depreciation and credited the asset by 60,000, what is the balance in asset account? The balance in asset account will become 40,000. So your gross block will become 40,000. Your net block will become 40,000 and egg debt will become 0 because we have debited the entire egg debt. And now when your balance in asset account will become 40,000, okay, then you need to credit your asset. Then you need to debit your asset account debit 20,000 to revaluation surplus OCI, 20,000. So this is known as a net approach. Okay. So cost of the gross block, the cost of the asset was 1 lakh and the accumulated depreciation was 60,000. Okay. So net block was 40,000. Okay. In the gross approach, what we have done, we have not debited our accumulated depreciation. We have restated, we have inflated accumulated depreciation as well as we have inflated gross block, so that gross block minus egg debt will become your fair value. Okay. So 1,50,000 minus 90,000 is equal to 60,000. In the net approach, we have eliminated the existing accumulated depreciation. So the accounting entry was egg debt account debit to asset account by 60,000, which is existing depreciation. Okay. Now the balance in asset account becomes 40,000. When you have debited your egg debt, then egg debt becomes 0. Your gross block will become 40,000. Your net block will become 40,000. And after that, just to compare, you have compared your existing value with the revalued amount. So you have debited the asset by 20,000 and credited the revaluation surplus by 20,000. So this revaluation surplus will always become 20,000. Okay, going by the gross approach or going by the net approach, whatever it may be. Okay. So now I am taking you with the institute study material. One of the example which is given in the institute study material. Are you able to see the study material? Please confirm. Illustration number 3. Illustration number 3, page number 7.43. Are you able to see this? Accumulated depreciation at the date of revaluation. Jupiter Limited. Are you able to see the institute study material on the screen? I have shared the screen. Jupiter Limited has an item of property, plant and equipment with an initial cost of rupees 1 lakh. Okay. At the date of revaluation, accumulated depreciation amounted to rupees 55,000. So what is the gross block? What is the cost? What is the cost here? The cost is 1 lakh. Okay. What is the accumulated depreciation? Guys, what is the accumulated depreciation? The cost is 1 lakh. The accumulated depreciation is 55,000. So 1 lakh is the cost. Accumulated depreciation is 55,000. So what is the net block? 45,000. And the fair value is 65,000. What is the revaluation surplus? What is the revaluation surplus? It is 20,000. Is the revaluation surplus. Okay. Okay. So there are two methods. One is gross method, one is net method. One is gross, one is net method. Okay. So first of all, let's move to the net method. In the net method, what we have done? We have eliminated the existing accumulated depreciation. So this 55,000 will be eliminated. What will be the accounting entry? Accumulated depreciation account debit to asset account, 55,000. So now what will be the cost of the asset? Now the balance in the asset account become your 45,000. Then after that, you have debited your asset cost by 20,000 and credited the revaluation reserve by 20,000. So now your asset becomes 65,000. Okay. So this was your net approach. So 1 lakh was the total cost. Then you have removed 55,000. You have reversed 55,000 and you have added revaluation surplus of 20,000. Now the balance becomes 65,000. So this was the net approach. Now what is the gross approach? Method number 2. So what was the carrying amount? Carrying amount was 45,000. What is the total fair value amount? 65,000. What is the revaluation surplus? 20,000. What is the percentage increase? Percentage increase is 20,000 divided by 45,000. 44.44%. 44.44%. 20,000 divided by 45,000. 20,000 divided by carrying amount. Revaluation surplus divided by carrying amount. 44.44%. Okay. So in this case, what you have done, you have inflated your asset by 44.44%. Asset account debit 44,444. You have inflated your accumulated depreciation by 44.44%. So 55,000 was the existing accumulated depreciation. 55,000 multiplied by 44.44%. It is 24,444. And the difference will go to revaluation reserve, so revaluation surplus, which is 20,000. So revaluation surplus will always become 20,000. Okay. I mean to say, going by the net approach or going by the gross approach, it will be same amount. Okay. So by the help of this particular case study, illustration number 3, you have also got the revision of the concept. Okay. Same case study I have solved while explaining the concept. So Purushottam, please try to understand. First of all, you need to understand the basic concepts. Okay. So if there is an increase in, it is not overriding the rule of conservatism. So that is why if there is an increase in the fair value, it will go to OCI. What is other comprehensive income? Other comprehensive income is nothing, it's a reserve. Even in our old accounting standard, if there was a revaluation surplus, we were not crediting our P&L. We were crediting our revaluation surplus reserve. Okay. And here also we are crediting a reserve, which is OCI reserve. And OCI is non-distributable. Okay. It is not available for distribution for dividend. So it is not overriding any concept of conservatism. So friends, do you have any query so far on account of revaluation? We discussed cost model, we discussed revaluation model. Now the question comes into picture that the company needs to apply this model consistently. Okay. So if on a particular class of asset, a company is applying cost model, it has to apply cost model for that entire class. Okay. If the company is applying a cost model for a particular asset, so revaluation model for a particular asset, it has to apply the revaluation model for the entire asset in that particular class. Okay. Okay, perfect. So let's move on to the next part. So before moving on to the next part, let's have a 10 minutes break. Let me see if there is any query, or if you have any query till the if you have any query for the concept I have explained you so far, please write down your query in the query box. I'll take that query after 10 minutes of break. So it's 8:45 now. We'll start at 8:55. Okay. Welcome again, students. After the break, let me answer the queries which you have raised in the break time. So Rohita is asking, sir, in revaluation model, we arrive carrying value of asset at fair value, and even in the gross approach and net approach also, we arrive carrying value of the asset at fair value. Then which should we follow? So Rohita, there is an option which is given in the standard. You can follow any of them, either a gross approach or a elimination approach, which is a net approach. So you can follow any of them. Okay, so whatever suits you. Purushottam is asking, sir, the word gross carrying amount used in the standard, what is difference between carrying value and gross carrying amount? Purushottam, again I am telling you, the gross carrying value is nothing, it's a gross block. It's a gross block. Okay. So you must have seen that gross carrying amount in the gross approach and net approach. Okay. So in the gross approach, the word gross carrying amount has been used, which says that gross carrying amount is required to be restated and accumulated depreciation is required to be restated. Okay. So gross carrying amount is nothing, it's a gross block. Okay. Or the value of the asset or the cost of the asset. Okay. Gross value. And carrying amount is the net value. Original cost or revalued amount minus accumulated depreciation minus accumulated impairment losses. Okay. Pujita is saying, sir, just a clarification in the study of revaluation surplus utilized. So Pujita, let me tell you, I have given an example of 10 lakh and 12 lakh. So I have taken a cost of 10 lakh. The life is 10 years. Per year depreciation is 1 lakh. And I have taken a revaluation amount of 12 lakh. So the revaluation surplus is 2 lakh. Okay. And I have assumed that the revaluation has been done at the date of original date, at the date of original acquisition. So this 2 lakh, due to this increase of 2 lakh, I mean to say the total value is 12 lakh, divide by 10, the depreciation is 1.2 lakh. So I have calculated the excess depreciation of 20,000 and I have transferred revaluation surplus to retained earning to the extent of excess depreciation every year. But if you will calculate like for 3 lakh, for example, original cost was 10 lakh, life is 10 years. Okay. Now, what is the depreciation at the end of first year? It is 1 lakh. Carrying value is 9 lakh. And 12 lakh is the revalued amount. 12 lakh is the fair value. So what is the revaluation surplus? 9 minus 12 or 12 minus 9. 3 lakh is the revaluation surplus. Okay. So what is the excess depreciation? Excess depreciation. What is excess depreciation? So excess depreciation will be 12 lakh divided by 9 because the remaining life is 9 minus 9 lakh divided by 9. So 12 lakh divided by 9, how much? 9 1 ja 9 or 3. So let me take my calculator first. So 12 divided by 9 is coming out at 13.33, sorry, 1.33 lakhs minus 1. So 0.33 lakhs is the excess depreciation. So in this case, every year till the next 9 years, every year you will debit your revaluation surplus by 0.33 and credit your retained earning by 0.33, so that your 3 lakh will become 0. Your 3 lakh will become 0 at the end of 9 years. Okay. So just you need to understand the concept. Okay. What is the concept? Pujita, now you are clear on this? Are you clear on this now? Purushottam, are you clear on gross carrying amount? Purushottam, are you clear on gross carrying amount? So gross carrying amount is a gross value. It's a gross block. Okay. So friends, now in measurement after recognition, I am moving on to a concept of depreciation. Under accounting standard earlier, there was a separate standard on depreciation. It was AS6. But in 2016, this AS6 was demised and it was incorporated into AS10 just to make it in line with Ind AS 16. So in Ind AS 16 also, the entire concept of depreciation is given under this particular standard. Okay. So now we are moving to depreciation concept. Again, an important concept, depreciation. First of all, what is depreciation? Tell me, what is depreciation? Guys, what is depreciation? Just tell me quickly. So depreciation is nothing. It's a consumption of the asset. It's a consumption of the asset. So depreciation is the consumption of the asset. Depreciation is the consumption of the asset. And depreciation is the systematic. If I talk about exact definition, depreciation is the systematic allocation of depreciable value, systematic allocation of depreciable value or depreciable amount over the useful life of the asset. So depreciation is a systematic allocation of depreciable value over the useful life of the asset. What is the depreciable value? What is the depreciable value? What is the depreciable value or depreciable amount is equal to cost minus residual value or scrap value. For example, 1 lakh rupees is the cost of the asset and the company is expecting a residual value of 10,000, then depreciable amount is 90,000. Okay. And if the life is 10 years, if the life is equal to 10 years, then what is the depreciation? What is the depreciation? It is systematic allocation. It is systematic allocation of depreciable value over the useful life. So depreciable value we have calculated 90,000, life 10 years. So what is depreciation? Systematic allocation. So we are allocating 90,000 over the useful life, which is 10. So 9,000 is the depreciation which has to be charged every year. So this is known as a depreciation. Now, what are the different methods of depreciation? Whether systematic allocation means charging an equivalent depreciation every year. So what are the different method of depreciation? Friends, are you clear on the aspect which I have explained so far? Any doubt, any query so far, any problem? Okay. So now there are three methods of depreciation. Can you tell me the different methods of depreciation? Depreciation method. SLM, straight line method. SLM, straight line method. What is the second method? Can any of you help me? In recognizing what is the next method of depreciation after SLM? WDV. The next method is WDV. It is WDV. Written down value method. It is also known as a diminishing balance method. Yes, you are right. Few students have replied. Okay. Great. So 3 students have replied that, sir, it is unit of production method or unit of digit method. Unit of production method. Great. Unit of production method. Now, when to apply these methods? So what is depreciation? Depreciation is the consumption of the asset. So you are consuming the asset. Okay. Depreciation is the consumption of the asset. Since you are consuming the asset, that is why you are depreciating the asset. Technically speaking, you are creating a fund for that asset. Okay. For example, you have purchased a machinery for rupees 1 lakh and the life of the machinery is 10 years. Okay. So it means after 10 years, the replacement will be required. So after 10 years, there will be a huge cost in terms of replacement of a machinery. So that is why you are doing a systematic allocation of the value of that machinery so that after 10 years, you have an accumulated depreciation of rupees 1 lakh. I mean to say, you have debited your P&L by rupees 1 lakh so that in a single shot, 1 lakh rupees amount of expense will not arrive into the P&L. Okay. So this is like This is like a staggering of the consumption of the asset. Okay, since you are getting an output of the asset, so going by the matching principle, this asset is providing you future economic benefit, this asset is providing you output, so that is why you are required to charge your expense also. Okay, so it is a consumption of the asset. When straight line method is required, straight line method is required when there is a similar or equal consumption, or equal usage. Consumption means usage, equal consumption or equal usage of the asset. WDV, when WDV is required, when the asset is used or when the asset is providing output. Okay, when the asset is providing higher output, high consumption or usage, high consumption or usage in initial years, then it will go down. Okay, then it will go down. Okay, so proportionately the consumption or usage is decreasing. When unit of production method is applicable, unit of production method is applicable. So I'll take an example to explain this concept of unit of production method. Have you purchased a LED? Have you purchased a projector? LED projector, LED bulb, LED light. So when you go to purchase a projector machine, then when you ask for a life of the projector, he will not tell you the life in terms of years. He will not tell you the life in terms of years. He will not tell that the life of this projector is 10 years, 5 years, 2 years. He will tell the life of the projector is let's say 10,000 hours, is 20,000 hours. Am I right? Does any of you have purchased a projector or LED related something? LED lights. When you go for LED, when you go to purchase for a LED lamp or LED bulb, when you ask for a life, you will not say life is 2 days or life is 1 year. Okay, so it can be break even in a moment. So when you ask for a life, he will tell that the life of the bulb is, let's say, 100 hours. Okay, so it means the asset, the life of the asset, which is on the basis of their usage, which is on the basis of their capacity of usage, has to be depreciated over a unit of production method. For example, when you purchase a particular machine, so generally in case of some specific machines, the life of the machine is as per the quantity. Okay, as per the quantity. For example, a Xerox machine. So the life of the Xerox machine is not equivalent to, let's say, 10 years, 15 years, or 20 years. They will say this Xerox machine is the life of this Xerox machine is to photocopy 10,000 copies, photocopy 10,000 papers, 20,000 papers. Okay, so it means the life is in terms of capacity. For example, aircraft, the life could be 1 lakh flying hours. For a ship, the life could be 1 lakh sailing hours. Okay, so in such cases, when the life associated with the asset is on the basis of capacity, then it has to be charged. Depreciation has to be charged on the basis of production, unit of production. For example, the cost of the projector is 50,000 rupees and the total life is 25,000 hours. And in the first year, the company has used only 5,000 hours. So 50,000 divided by 25,000 hours multiplied by 5,000 hours. So how much amount? 10,000 amount of depreciation is required to be charged. In the second year, the company has used 15,000 hours. So in that case, 30,000 amount of depreciation is required to be charged in the P&L in the second year. Okay, have you understood these three concepts? Change in depreciation method. Now the question arises, change in depreciation method will be considered as a change in policy or change in estimate? Weighted average is not a method. It's a written down method. Weighted average is not a method for charging depreciation. Friends, my question is, in case of a change in method of depreciation, for example, the company was charging SLM method, now the company has shifted to WDV method. Is it a change in policy or change in estimate? Is it a change in policy or change in estimate? This is considered as a change in estimate because the consumption pattern is changing. Why the company has changed the method of depreciation? Because the consumption pattern is changing, and that is why this will be treated as a change in estimate. And this has to be applied prospectively. In case of a change in depreciation method, yes, Chavi, you are right. Kaustav, Preeti, Ambika, Rohan, yes, you all are right. So Ambika, it is not a change in policy. Ambika, it is change in estimate. Okay, it is not a change in policy. The standard says that change in depreciation method is considered as a change in estimate, and it has to be applied prospectively. Because why you will change the depreciation method? Because it is as per the change in consumption pattern, and estimate is defined as a change in the assets and liabilities due to change in the consumption pattern of that asset and liabilities. Okay, great. So friends, now I am sharing my PPT on the screen. Just confirm if this is visible. So depreciation, I have told you that it is a depreciable amount of an asset which has to be allocated on a systematic basis over its useful life. Depreciation charges should be recognized as an expense unless they are included in the carrying amount of another asset. What is this concept? For example, the company is using a machinery in a production site. Okay, so the company is using a machinery for the construction of a plant or a construction of a factory site. In that case, the depreciation of that machinery will not charge to P&L. The depreciation of machinery will be form part of the cost of that particular construction site. Okay. Component approach, we have discussed that the cost of the asset has to be split into the significant component. Okay, and these significant component has to be shown separately under the fixed asset register. Okay, if they have a different useful life. If they have a different useful life. For example, in case of an aircraft, you can split the component as an aircraft and aircraft. So engine, other than engine, and inspection. Okay, in case of a vehicle, you can split it as an engine or other than engine. Okay, so you have to see how it is going to be splitted. For that, the support of technical engineer or technical expert may be required. But my dear friend, we have discussed about the component approach, and going by the component approach, the major inspection, major overhauls, and major replacement cost is required to be shown as the separate component of a particular asset. Okay. Each major part of an item of property, plant, and equipment with cost being significant in relation to total cost of the item should be depreciated separately. So Purushottam, you remember in example of a cost of tire and tractor. So I have told you if it is a significant and the life is different, it has to be depreciated separately. Otherwise, it is not required. So Purushottam has one question. Sir, which rate of interest to be taken by the companies to compute the present value of by using the method of discounting, bank rate or any other rate? Is the company required to disclose discounting rate in the financial? Please tell me, sir. Yes, Purushottam, it will be a bank rate. If the company will go to take a loan from a bank for next 10 years, then what is the bank rate for 10 years? So it will be, of course, a risk-free bank rate. And second, the company needs to disclose the discount rate in the notes to accounts. So now we are discussing some important concept for depreciation. A very, very, very important part for depreciation. So let me move on to the whiteboard. Yes, what are the important concepts? First of all, depreciation starts when asset is available for use. The concept is not put to use, it is available for use. When asset is available for use. Okay. When the asset is available for use. What is meant by available for use? When the asset is in the location and condition necessary it to be capable of operating in the manner intended by the management. Simple. So as simple as that. when the asset has already brought in into the location and condition for making it productive as per the management. Okay, so when it is available for use, depreciation is charged. It is charged up to the residual value, up to the residual value. Okay, what does it mean? It means if a cost of the asset is 10 lakh and the residual value is 50,000, in that case depreciation is required to be charged when it reach up to the residual value. After that, depreciation has to be stopped. So depreciation has to be charged maximum for 9.5 lakhs. Okay, because 50,000 is recoverable and hence there is no depreciation for 50,000. Depreciation should be stopped. It should be stopped when asset is classified as held for sale, and then it will go to Ind AS 105. It will not remain in Ind AS 16. It will go to Ind AS 105, and Ind AS 105 says that whenever the asset will be classified as held for sale, the depreciation will be stopped at that particular point of time. Okay. Depreciation does not stop. Depreciation continue when even though asset is lying idle. So this was a very big point in this corona time, in the lockdown, when the factory was locked down and when the shops, factories, establishment, business was locked down for 2 months or 3 months. Okay, so companies were asking whether we need to charge depreciation because lockdown was there and we have not used our assets. So institute has clarified, and even with the reference of this particular standard, that the asset was available for use and hence you need to charge depreciation even for the lockdown period. So depreciation will not stop even though the asset is lying idle. Okay, is it okay? So friends, again I'm sharing my screen. I mean to say my PowerPoint presentation. Please confirm if it is visible. So depreciation method we have discussed. Depreciation method adopted should reflect the pattern in which the asset's future economic benefit are expected to be consumed by the entity. If there is significant changes in expected pattern of consumption, method of depreciation to be changed in line with the future benefits. Straight line method means constant charge. Written down value method means diminishing charge. Sum of unit method means charge. Depreciation charge based on the expected output. So we have explained all these concepts. We have discussed all these concepts. Change in method is accounted for as a change in accounting estimate and it has to be applied prospectively. Okay, so we have covered this part also. Now let's come to a case study. Illustration number 7. Change in depreciation method. Are you able to see this illustration? Guys, are you able to see this illustration? Illustration number 7. Change in depreciation method. An entity acquired an asset 3 years ago at a cost of 5 million. 5 million means 50 lakhs. Okay. The depreciation method adopted for the asset was 10% in reducing balance method. So the company was using WDV method, which is 10% WDV method. Okay. So 50 million was the cost. Okay. At the end of year 3, the entity estimates that the remaining useful life of the asset is 8 years. Okay. And determined to adopt straight line method from that date so as to reflect the revised estimated pattern of recovery of economic benefit. You are required to show the necessary treatment in accordance with Ind AS 16. Okay. So what we are required to do here, whether this question is clear to everyone? Is it clear to everyone? Okay. So now I am moving on to the whiteboard. It is clear to everyone. The question is saying the cost was 50 lakh. And the method of depreciation is WDV at the rate of 10%. Okay. So WDV at the rate of 10%. So what is the first year depreciation? Depreciation. First year. How much? This is 5 lakh. What is the WDV at the end of the first year? 45 lakh. What is the depreciation for second year? It is 4,50,000. What is the WDV? 40,50,000. Depreciation third year, it is 4,05,000. It is 36,45,000. 36,45,000. Okay. So what is the WDV at the end of the third year? 36,45,000. Okay. And the question says that at the end of year 3, the entity estimates that the remaining useful life of the asset is 8 years. So at this point of time, the company has estimated the remaining life of the asset, which is 8 years, and decided to go for SLM. Then what will be the accounting treatment? So this balance, this opening WDV of 36,45,000 has to be depreciated over a period of 8 years on a prospective basis. Okay. So in this case, it will be treated as a change in estimate. Okay. And what will be the depreciation? What will be the depreciation going forward? So depreciation from 4th year to 12th year. Because 8 years is the life, this will be per annum depreciation will be 36,45,000 divided by 8. So every year depreciation will be 4,55,625. So this is the solution which is given under the study material. Okay. So it is a prospective effect. It is not a retrospective effect. Okay. Yes, Vaibhavi, Ambika, you're right. Okay, friends. Now I'm again sharing my PPT. So this case study we have discussed. Change in estimate. Okay. So useful life and residual value. Now the standard says that useful life, okay, life of the asset, and residual value, depreciation method, these three items are required to be reviewed at every year end, at least once in a year. Okay. So useful life, residual value, depreciation method is required to be reassessed at every year end. And if there is any change in the useful life or residual value, the same is required to be considered as a change in estimate. It is not a change in policy. It is a change in estimate. And this change is applied on a prospective basis. Like we have seen in our entire India 16, wherever there is a change due to revaluation model, wherever there is a change in amount. So we are doing a prospective charge, not a retrospective calculation. Okay. So future annual depreciation will be revised basis the new useful life or basis the change in residual value. Okay. So accordingly, depreciation method will also come into the picture. So this is a change in estimate, not a change in the policy. Okay. Now we will solve illustration number 12. So XYG Limited, illustration number 12 of the Institute study material. Yes. Illustration number 12 at page number 7.57. XYZ Limited purchased an asset on 1st January 2000, or let's say 2010, 20x0 for rupees 1 lakh, and the asset had an estimated useful life of 10 years and a residual value of nil. So the company has purchased an asset on 2010. The cost of the asset was 1 lakh and the life of the asset was 10 years. Residual value was 0. So these three numbers are given in the question. So I'm writing on the board that cost is 1 lakh. Okay, life is 10 years and residual value is equal to 0. Okay, the company had charged depreciation using the straight line method at 10,000 per annum. So the company is using SLM. If the life is 10 years and the residual value is 0, cost is 1 lakh, then the depreciation will be 10,000. On 1st January 2014, the management of XYZ Limited reviews the estimated life and decides that the asset will probably be useful for a further 4 years. Okay. So on 1st January 2004, it means after how much years? So January 2004, January 2010 to January 2014. So 31st December 2010, 31st December 2011, 31st December 2013, and 1st January 2014. So 3 years. After 3 years, the remaining life should be 7 years, but the management is estimating that the remaining life is left for only 4 years. Okay, and therefore the total life is revised to 8 years. Okay, so basically it's okay, perfect. 2010 to 2014, 4 years have been elapsed and 4 years have been left, so total 8 years. Okay, how should the asset be accounted for the remaining years? So how should the asset be accounted for the remaining years? Tell me. So again, earlier the life was 10 years. After 4 years, the life was revised to, so technically speaking, this will be a change in useful life and it has to be applied on a prospective basis. So what is the total depreciation from 1st January 2010 to 1st January 2000? It's X0 2002 or 30 to 31st December 2003. So 4 years, total 4 years are there. 2001, 2, 3. 4 years are there. What is the total depreciation? Per annum depreciation is 10,000 into 4. So 40,000 is total depreciation. Okay. So what is the WDV? WDV at the end of 4th year is 60,000. 1 lakh minus 40,000. What is the remaining life? What is the remaining life? The revised life. The revised life is 4 year remaining. So next year, in the next 4 years, the depreciation will be changed prospectively, and it will be, so depreciation from 5th year, from 5th to 8th year will be prospective. 60,000 divided by 4 is equal to 15,000. So this is the accounting treatment. Okay. Yes, this will be the accounting treatment. So change in useful economic life of an asset is a change in estimate, which is to be applied prospectively. That is, the depreciation charge will need to be recalculated. On 1st January 2004, when the asset's net book value is 60,000, the company should amend the annual provision for depreciation to charge the unamortized cost, namely 60,000, over the revised remaining life of the 4 years. Consequently, it should charge depreciation for the next 4 years at 15,000 per annum. Okay. So friends, now there is a concept of impairment which we will cover in Ind AS 36, but just I want to highlight, or I want to just summarize here. So what is impairment? It is technically over and above of depreciation. Okay. So the standard says that the carrying value needs to be compared with the recoverable value. Okay. For example, the carrying value is 1 lakh and the recoverable value is 90,000. Okay. In that case, impairment loss is required to be charged for 10,000. Okay. For rupees 10,000. And the revised value after charging impairment loss will be the opening WDV for calculating depreciation in the future years. Okay. So we will discuss the concept of impairment in detail when we will cover this Ind AS 36 impairment of assets part in the next week. Okay. Okay. So the concept of impairment is also there, which we will take in Ind AS 36. But for the time being, you are already aware that whenever the carrying value is higher than the recoverable value, then there is a need to charge impairment loss. Okay, understood? Understood, friends? Do you have any query regarding this impairment part? Please let me know. Please let me know if you have any query regarding this impairment part. Okay. So if there is any compensation for impairment, so standard says that, for example, the company will be able to receive a compensation for impairment from a third party. Then what will happen? In that case, standard says that this impairment loss will go to P&L, and if there is any compensation for impairment, for example, government is saying that the value of the land, if the value of the land or building will become less than this threshold or this amount, we will compensate you for that. Okay, we will compensate you for that. So compensation for impairment will not be charged to P&L, will credit to P&L. Okay, will be recognized in P&L when it becomes receivable, when there is a certainty for receipt of this compensation. Okay, so it will be credit to P&L. Okay, is it okay? Perfect, perfect, guys. So now the last part of this standard, retirement and disclosures. Of course, I'm not going to discuss the disclosures. You just need to read the disclosures. Okay, it is a theoretical part, and the best way to reading the disclosure is to read the annual reports. The best thing. Okay, so coming to the retirement and disclosure. So friends, we have discussed the initial recognition, initial cost, subsequent cost. We discussed the definition of PPE. We discussed the measurement at cost. We discussed the measurement at initial recognition, measurement after recognition, cost model, revaluation model, utilization of revaluation surplus, treatment of revaluation surplus. Okay, restatement of gross block and accumulated depreciation in case of reaching to the revalued amount. Then we discussed entire depreciation concept. We discussed changing useful life concept, residual value concept, impairment concept, compensation of impairment concept. Now we are discussing the accounting when the asset will come to an end. So we are discussing the accounting for retirement and disposals. Okay, so the carrying amount of the asset is required to be derecognized. The carrying amount of the asset is required to be derecognized. When? Tell me, when the asset is required to be derecognized? When the asset is required to be derecognized from the books of accounts? Tell me, when asset is required to be derecognized? When the asset is required to be derecognized? Can anyone help me in understanding when the asset is going to be derecognized? The asset is going to be derecognized when it is sold or disposed of. Of course, when you are discarding, when you are disposing of the asset, when you are disposing of the asset, when you are selling the asset, or when the asset has stopped providing a future economic benefit. So the future economic benefit has been stopped from getting the asset. Okay. For example, the company was using a particular machinery. Okay, so the life of the machinery was 10 years. After 6 years, government has banned the output which has to be produced from that particular machinery. Or the company was using a diesel car. After certain years, government has banned the diesel cars. In that case, that asset is required to be derecognized and charged off to the P&L. Okay, when the future economic benefit has been stopped. Or of course, if you are actually selling the asset, actually discarding the asset, in that case, asset will be derecognized. Okay. Yes, you're right, Shavi. Pujita is saying when it is used, when its use is over and had no future economic benefits. Yes, you're right. In case of disposal, yes, of course, yes. So friends, when there is a loss on derecognition, where it will go? When there is a profit or loss on derecognition, where it will go? It will go to P&L. It will go to P&L. But in P&L, where it will go? Whether it will go to revenue? Answer is no, it will not go to revenue. It will go to other income. It will go to other gains, other income. Okay. So revenue is a main line item which is arise due to operation. For example, for a cement manufacturer, ACC Limited, sale of cement is a revenue. Okay, but interest on FD, interest on FD, profit on sale of machinery. Okay, these are the other income. Okay, so other income or other expenses, it will go to P&L. But if there is a gain, it will go to other income. Gain will not go to revenue. Gain will not go to revenue. Okay. Understood? Yes, great. Now, one of the participant, Usha, was asking for illustration number 1. So, who all wants me to solve the illustration number 1, which is on deferred payment credit? Who wants me to solve the illustration number 1, which is on deferred payment credit? Please respond quickly. So friends, till the time you're responding, so let's check our understanding. We do have some multiple choice question, okay, for you. A change in depreciation method is a change in accounting policy, a change in accounting estimate, a change in accounting method, or change in accounting standard. Which is the right answer? Which is the right answer? Tell me quickly. A change in depreciation method, WDV, SLM, unit of production method. Is it a change in policy? Is it a change in estimate? Change in accounting method? Change in accounting standard? Which is the right answer? Great. Absolutely great. Yes, it's a change in accounting estimate. It's not a change in policy. It's not a change in standard. It's not a change in method. It's a change in estimate. So 11 participants have responded. Yes, it's a change in estimate. Great. Great, guys. Great. Yes. So it's a change in estimate. Para 61 says that change in depreciation method shall be accounted for as a change in estimate in accordance with Ind AS 8. Sir, do we need to learn the para numbers for the purpose of examination? No, you are not required to learn the para numbers. You are only required to understand the concept which is given in the standard. When an asset is sold or disposed of, where is the gain or loss recognized? Oh my God. So just 2 minutes before, I have explained this concept. Asset disposal account, profit and loss, revaluation reserve, depreciation. What is the right answer? When the asset is derecognized, where the gain or loss will be recognized? Is it into asset account? Is it into revaluation reserve? Is it into depreciation? Where it will go? Wonderful, wonderful. Yes, it will go to P&L. Yes, it will go to P&L. Para 68 says that the gain or loss arising from the derecognition of an item of PPE shall be included in the profit or loss. Absolutely fantastic. Under Ind AS 16, how often should the useful life of an asset be reviewed? At least at each financial year end, every 6 months, at management discretion, or never? You guys are so spontaneous. Great. Yes, it has to be reviewed at least at each financial year end. Yes. Right answer is answer A. Para 61 says that the depreciation method applied to an asset or a useful life shall be reviewed at least at each financial year end. So para 61 also talks about the useful life. Question number 4. How should an item of PPE be initially recognized in the financial statement? Market value, cost, NRV, and fair value. So it is talking about measurement and initial recognition. It is talking about measurement and initial recognition. So what is the right answer? What is the right answer, friends? Let me see at the query box. Yes, perfect. It has to be measured at cost. Remember, initially the asset is required to be measured at cost, and cost includes purchase price, import duties, plus non-refundable taxes, minus trade discount and rebates, plus directly attributable cost, plus estimated cost of dismantling. Yes, it is required to be measured at cost. Great. 14 participants have replied the right answer. Great. Para 15 says that an item of PPE that qualifies for recognition as a PPE shall be measured at cost. If one large asset has a number of individual components with different useful life, how should this be depreciated? Treat as one asset, break down into different components, expense it all, and treat as one asset but disclose in notes to the financial statements. What is the right answer? Guys, what is the right answer? Absolutely perfect. Absolutely perfect. It has to be broken down into a different component. Yes, it has to be broken down into a different component. Okay. So I've told you, if a single asset has a different component which have a different useful life, it has to be broken down into a different component. But if a single asset has a significant component but a single life, but a same life, similar life, in that case it has to be shown as a single asset and it can be disclosed in the notes to accounts. So yes, para 43 says that each part of an item of PPE with a cost that is significant in relation to the total cost of the item shall be depreciated separately. Great, friends. Under Ind AS 16, which two subsequent accounting treatment are allowed subsequent to initial recognition? Cost model and present value model, cost model and revaluation model, fair value and revaluation model, fair value and cost model. So which is the right approach which is given under the standard? Very simple question, sir. Which is the right approach? I want at least 20 answers. Perfect, guys. Perfect. Yes, it is cost model and revaluation model. Para 29 says that an entity shall disclose either the cost model or the revaluation model as its accounting policy and shall apply that policy to the entire class of property, plant and equipment. Absolutely fantastic. Great. Question number 7. When it is dashed that future economic benefit associated with an asset will flow to the entity and the cost can be dash measured, it should be recognized as an asset. So you need to fill in the blanks. Possible reasonably, possible reliably, probable reliably, probable reasonably. So these are the recognition condition given. You remember the recognition condition. When it is, which is the right answer? So let me see how many students will reply the correct answer of this question. Pujita is saying possible reliability. So probable reliable, probable reliably. Yes, the right answer is when it is probable that future economic benefit will receive and the cost can be measured reliably. So the right answer is probable and reliably. So right answer is C. Para 7 of Ind AS 16 says that the cost of an item of PPE shall be recognized as an asset if and only if the future economic benefit is probable and cost can be measured reliably. Okay. Question number 8. Which of the following is not an asset that falls under the scope of Ind AS 16? So which is not falling under the scope of Ind AS 16? Tangible asset? Of course, it is in the scope of Ind AS 16. Asset held for the production or supply of goods or services. Asset held for the sale in the normal course of business. Asset expected to be used for more than one period. Tell me, which asset is not covered under the scope of Ind AS 16? Which is not covered under the scope of Ind AS 16? Yes, asset held for sale in the normal course of business, because asset held for sale in the normal course of business is not a PP, it's inventory. For example, car. You are purchasing a car, so it's a PPE for you. But Maruti is manufacturing a car, so Maruti is selling the car in the normal course of business. So it is not a PPE, it is an inventory. Okay. Yes, you are right. Assets which are held for sale in the normal course of business are accounted for under Ind AS 2 inventories. Question number 9. When the revaluation, sorry, you have seen the answer also. When the revaluation model is used for PPE, the gain or loss should be included in income for the period. Gain from the revaluation on the income statement, a revaluation surplus account in the other comprehensive income, and extraordinary gain or loss in the income statement. So where the revaluation surplus will go, where the gain will go? Yes, it will go to revaluation surplus account in OCI. You remember, if there is a gain, it will go to revaluation surplus in OCI. If subsequently there is a loss, to the extent of gain, it will be debited from the gain and rest will go to P&L. Okay. In case of a loss, it will go to P&L. If there is a subsequent increase, to the extent of loss, the increase will be credited in the P&L. And if it is over and above that, it will go to OCI. Okay. Para 39 says that if a revaluation results in increase in value, it should be credited to other comprehensive income and accumulated in the equity, I mean to say reserves, under the heading revaluation surplus, unless it represents the reversal of a revaluation decrease of the same asset. If it was a revaluation decrease, so it will go to P&L. Otherwise, it will go to OCI. Previously recognized the next phase, in which case it should be recognized in profit or loss. Okay. Last question, just to check your understanding. Which of these is an allowable cost of an asset under Ind AS 16? Please remember, directly attributable cost, allowable cost, not allowable cost. You remember, I have told you the example of directly attributable cost, and I have told you what is the not an example of directly attributable cost, like cost of training, like promotional cost, advertisement cost, cost of inauguration. You remember, I have taken an example of Amitabh Bachchan. General and administrative overheads. You remember, initial losses. So what is the right answer for 10? Yes. So the allowable cost is only professional fees. Para 17 says that professional fees are allowed as a cost of an asset so long the cost incurred is directly related to the asset. Okay. So thank you very much. So one of the participants was requesting for illustration number 1, which is on deferred payment credit. Although I have asked it again, but I believe that participant is not there. So I request you to please go through with the first class which was there on Saturday. So I have explained that concept in detail. Okay. And I request everyone to please solve all the case studies from the study material. So you're required to solve all the case studies from the study material. So this is your homework. Okay. So let me see if there is any query. Otherwise, I will wrap up the class in the next 5 minutes. So it's 9:50 now. So we have 10 minutes. So let me see if there is any query. Please ask if you have any query. Or you have a problem in understanding of any concept from Ind AS 16. Please let me know. So wonderful participants, wonderful participation by all of you. I really admire and appreciate. So thanks, Anjali. Guys, let me know if you have any query. So quickly, I am repeating the entire concept again, just for the sake of your benefit. So we have started with the objective part, why this standard was issued. So this standard was in line with the accounting standard 10, which have been revised as of now. So then we discussed about the scope. So we told that it is applicable to every kind of PP except PP classified as held for sale, PP related to agricultural activity, not PP biological asset related to agricultural activity. But if there is a bearer plant, then that bearer plant will be covered under Ind AS 16. Exploration for an evaluation assets, which is covered under Ind AS 106. If any PP is related to these assets, for example, tractor, which is used for agricultural activity, land, which is used for agricultural activity, these are covered under PPE standard only. Okay. Then we talked about the definition of PPE. PP are tangible item held for use in production or supply of goods and services, held for rental purposes, held for administrative purposes, and expected to be used for more than one period. But sir, if land and building is used for rental purposes, it is outside the scope of PP. It is an investment property. Then coming to the recognition, an item of PP is recognized as a PP if future economic benefit is probable and cost can be measured reliably. Okay. Then we talked about measurement at cost. We talked about that the PP is required to be initially measured at cost. Okay. And as far as recognition criteria is concerned, same criteria is there for initial cost as well as for subsequent cost. Subsequent cost, I mean to say major repair, major replacement, major overhauls, and major inspection. Okay. It is not for the minor cost like servicing, consumables, labor charges. So these kind of day-to-day cost is outside the scope of the PP standard. Okay. Then we discussed the cost component. The cost is purchase price, including import duties, non-refundable taxes, less trade discount and rebates, plus directly attributable cost, plus estimated cost of dismantling. Okay. Then we talked about the deferred payment credit concept. If a company has acquired an asset which is on the deferred payment credit, in that case, it has to be recognized as a PP on the cash price equivalent. The difference between the total consideration, which is 10 million in the illustration number 1, which is 1 crore, and 95 lakh was the present value. So the difference is 5 lakh. It will go to P&L as a finance cost. Okay. But if the asset is a qualifying asset, then it will be capitalized as per Ind AS 23 borrowing cost standard. Okay. Then we talked about measurement after recognition. So we discussed about cost model, revaluation model. Okay, treatment of revaluation surplus, utilization of revaluation surplus, and how to allocate the gross block and accumulated depreciation in terms of arriving at the fair value amount. Then we discussed about depreciation, we discussed about impairment, we discussed about change in useful life, change in residual value, discussed about derecognition condition, retirement and disposals. So this was overall which we have touched upon on this Ind AS 16 property, plant and equipment. I would request you all. So illustration number 4. So Ambika is asking for illustration number 4, and thanks Pujita for the appreciation. So quickly I'll run through with the illustration number 4. The revaluation model for entire class. Ambika, are you talking about illustration number 4, which is revaluation model for entire class, which is industrial building and office building, which I have covered? Ambika, quickly, can you confirm? Are you talking about the revaluation model for entire class illustration, which I have covered in the class today? Thanks, Kaustav, for your appreciation. So Ambika, quickly, I'll discuss. So the standard talks about if the company is opting for the revaluation model, it should be for the entire class. Okay. And the company have a different models for the different class of asset. So in this case, what is meant by class of asset? Class of asset means the asset which is having a similar nature and similar use in the entity's operation. So this office building and industrial building or factory building is different in use as far as entity's operation is concerned. Factory building is used for production. Office building is used for administration. So that is why these are considered as a different class of assets. And the intent of the company is right. The company can adopt the revaluation model for office building class, and the company can continue the historical cost model for industrial building class. So this is the concept which is given under illustration number 4. Okay. So guys, thank you very much. I have not seen any. So Ambika is now asking for illustration number 10. Illustration number 10. Okay. Ambika, are you talking about the term of an operating lease? Are you talking about page number 7.56? So let me share the study material. I think she is talking about illustration number 10. Ambika, are you talking about this illustration number 10? Okay, okay, great. So she is responding, yes, sir, got it. And now I got entire clarity of India 16. Great, great, guys. So thank you, friends. Thank you very much. But quickly, let me discuss this also. The term of an operating lease allows a tenant XYZ Limited to tailor the property to meet its specific needs by building an additional internal wall, but no condition that the tenant return the property at the end of a lease in the original state. This will entail dismantling the internal wall. XYZ Limited incurs a cost of 25 lakh on building the wall, and present value of estimated cost to dismantle the wall is rupees 10 lakh. At what value should the leasehold improvement be capitalized in the books of XYZ Limited? Okay. So friends, in this case, the leasehold improvement is not only the cost of building the wall, also but the cost of restoring the property at the end of the lease. And hence, both the cost, which is 25 lakh plus 10 lakh, I'm assuming this 10 lakh is also a present value. This 35 lakh are capitalized when the internal wall is built and will be recognized in profit or loss over the useful life. So friends, this is the same concept. It says that if you are acquiring a property or if you are acquiring any premises on a lease basis, if you are doing any restructuring or renovation, and if there is a site restoration obligation cost attached to that particular renovation, it is required to be capitalized. As simple as that. So this is the concept of illustration number 10. Yes, it is asset for the lessor. Yes, Ambika, you're right. It is not for the lessor, it is for the lessee. Ambika, it is for the lessee. Okay, because lessee is constructing the asset now. It is talking about tenant. Okay. So yes, so thank you very much, friends. Thank you very much, student. I request everyone to go with the entire question of the study material of ICAI. Stay happy, stay tuned. Thank you very much. God bless you.